Hi, I'm Don Davis. I'm a securities lawyer. This is the fourth in a series of videos that we have created to tell you about a little bit about the securities laws. And the last video was about equity investment in your company. Today we're going to talk about debt, simple debt. We'll get into a video later about convertible debt and some more exotic sorts of ways of finding money for your company. But today we're going to talk about simple debt, typically a promissory note. A lot of people think that a promissory note is not a security, that it's not subject to the securities laws, it's not regulated by the SEC or state blue skies laws. Totally wrong. It's clearly a security, and in fact it's defined in the Securities Act of 1933 specifically as a security. Well, what about bank debts and real estate loans secured by a trustee and so on? Well, those are all exceptions, and you're right, they are exceptions. They aren't covered by the securities laws. Commercial lenders, banks, finance companies, they're all regulated by other folks, and those folks are licensed by other regulations and not the SEC. But for your company, if you want to issue a note, collect capital, build a business, that's a security and you got to comply. That's just the way the law is. So the typical security is a note, and there's three basic things to think about, three elements of the note really. First, well, of course, is the amount. That's maybe the key thing. But beyond the amount, I'm assuming you have the amount in mind. You know how much you need to build your business. And so the three terms that are big variable terms in a note are: first, what's the interest rate? Second, what's the term? How long before you have to pay it back? And third, what's the payment schedule? Do you have to make payments along the way, or is there a big balloon payment at the end? You obviously, as the owner, would like to pay as little as possible on an interest for loans evidenced by a note. On the other hand, an investor would like to get as much as possible in interest rate on that note, or he's not going to write the check. So we have to find a happy medium between what you can afford to pay in interest and what an investor is willing to take in order to write the check and purchase a promissory note from you. And that's partly a discussion of market rates and alternative investments in the market. What can the investor get for his money in other markets? Realistically, you're going to have to pay more than the alternate sources of more secure investments, and that's just a fact of life. So first issue is interest rates. The second issue, of course, is the term. This is expensive money. It's going to be expensive money, or the investor is going to write the check. So you just have to start. You have to accept that. So the longer the term, the more the interest, the more expense in the obligation for you. So a shorter term is better from that perspective. On the other hand, it's got to be enough money to build your business, and you got to be at a point where you can pay the note back. Critical. You don't want to have a note out there that goes in default, and suddenly someone's suing you. Maybe they're going to lien your assets. Maybe they'll take over your whole business. That would be a disaster. So we don't want a note that's too short. It's got to be long enough so you can pay it back. And we don't want it too long because it's expensive money. So that's the term. So the third element is the payment schedule. It can be as little as zero. That is to say that it's all due at the end, a balloon note. That may be the most comfortable for you, but you got to make sure you've got that money available at the end to pay that balloon. Or it could be a level payment note. 3 years, level payments of interest and principal. And of course, the middle alternative is interest only, where you pay interest currently on the note, and then you still have a balloon payment in the form of the principal at the end. Finally, with note financing, simple note financing, there are add-ons to consider. How do we make this note more attractive to the investor so he'll write the check? Well, the investor is concerned with his profit, what's he going to get paid back, and his security. Is he sure he's going to get paid back? So one of the obvious things we can do is add security to the note. If we can secure the note with a significant asset that's otherwise unencumbered in your business, that may make it very much more attractive for the investor to write the check. At the same time, it may lower your interest rate, so that might be a good thing. Another option we often use is a personal guarantee. As a lawyer for businesses, I hate personal guarantees, but sometimes you need to give a personal guarantee to get the loan made, to get the job done so you can build your business to the next level. And sometimes there'll be other forms of inducement. Maybe a stock kicker. Maybe we'll give the investor who buys your note and writes the check some stock in your company. Not a lot of stock, a kicker, to sweeten the deal, to encourage him to write that check and be comfortable with his investment. There are a lot of other options, bells and whistles we can add to the simple note, but those are some of the basics. So there you go. I'm Don Davis. I'm a securities lawyer. I'd love to talk to you about your business. A free consultation for 15 minutes anytime if you give me a call. My telephone number is 213-400-2007. Don Davis, 213-400-2007. Thank you.